Hello C aspirants, welcome back to our channel C Aspirants Comfort Zone. Today we'll be revising complete costing formulas and also some key points that we should compulsorily remember for tomorrow's exam. Let's get into the video. Let's finish it very fast. Coming to cost sheet, the format is direct material consumed. We have to also include carriage inwards. We know how to calculate direct material consumed, right? That is opening plus purchases minus closing is equal to direct material consumed. Then we have to include direct labor, direct expenses, which gives us prime cost. Then we have to add factory overheads, which will result in gross factory cost. Then we have to add opening WIP and subtract closing WIP, which gives us net factory cost, plus QRAP, that is quality control, research and development, admin expenses if it is relating to production activity only. Then we have to subtract scrap or byproduct value, which will result in cost of production. We have to add opening finished goods minus closing finished goods, which will result in cost of goods sold. Then add the others, that is admin expenses, which is general. Here we saw only relating to production, here it is all about general. Then selling and distribution charges, like that is marketing cost, which will give you cost of sales. If we add profit to it, then we'll get the value of sales. Coming to next chapter, that is material costing. The formula for EOQ is root 2AO divided by C. A stands for annual demand, O is ordering cost, where C is carrying cost. EOQ is equal to EOQ units into cost per unit of raw material. Annual demand of raw material. O is ordering cost per order. This will get it as number of orders into ordering cost. Carrying cost per unit, we will calculate this by EOQ or demand divided by 2, that is average inventory into carrying cost per unit per annum. Here if they have given in percentage, we'll take on the price of the product and into the percentage that they have given. In this chapter we'll also see about reorder level, that is maximum consumption into maximum reorder period, or safety stock plus normal consumption into normal reorder period. Minimum level is equal to reorder level minus normal consumption into normal reorder period. Maximum level is equal to reorder level plus reorder quantity minus minimum consumption into minimum ordering period. Or we can also calculate this by EOQ plus safety stock level, that is maximum level. Average inventory level is minimum level plus half of ROQ, that is average, right? Or else we can also calculate it as maximum level plus minimum level divided by 2. We'll calculate danger level by minimum or normal consumption into maximum ROP for emergency purchases. The turnover ratios, like material turnover ratio, cost of raw material consumed divided by average stock of raw materials. Here we know how to calculate raw material consumed, right? Just like we saw in a cost sheet, we'll be calculating it in the same manner, that is opening plus purchase minus closing. We'll calculate average stock of raw materials just like that, opening plus closing divided by 2. Let's revise the other chapter so quickly, that is labor costing or employee costing, whatever we say. The rate of change in the consumption of labor force of an organization. There are a few methods which we'll be revising very soon. Separation methods. that is number of employees separated in a year divided by average number of employees on roll during the year into 100 will get separation method. Here this part, average number of employees on roll during the year, will remain same. According to the heading, the things will change, like number of employees separated in year, separation method. Replacement method, this will remain same. Average number of employees on a roll during the year, number of employees replaced in the year into 100. Coming to flux method, that is variant 1, number of employees separated plus number of employees replaced divided by, the denominator remains same, average number of employees on roll during the year. This we can just say that separation plus this is equal to flux method. Number of employees separated plus replaced divided by average employees. Coming to flux method 2, the variant 2, number of employees separated plus number of accessions joined, that is not replaced, only new members are joined, that is that newly joined, divided by average number of employees, that is opening plus closing. We already saw in many examples that average means opening plus closing divided by 2. So in flux method variant 2, will not consider replacement and separation, will consider separation and also the newly joined employees. Coming to labor turnover due to new recruitment, number of new employees joining in year divided by average number of employees. Labor turnover due to accessions, number of accessions in year, average number of employees. Accessions means we already saw here, not replaced, only new or joined. Instead of, they are not replacing the one in place of other, but they are getting the work from new people, like new jobs are assigned to new people. Then finding closing of labors, we can find it by workers in beginning plus workers replaced plus workers recruited under expansion minus workers separated, that is workers at closing. See, we have to add the replaced, workers recruited under expansion and workers separated. This is a common sense thing which will be knowing how much will be available, just like reconciliation. Annual labor turnover rate is labor turnover rate computed divided by days, months, as it is given. That means they'll be giving 360 or 365 days. In case of if we are calculating on months, it will be 12 months. Coming to the next thing, efficiency determination. We'll be calculating it on two things, that is output basis, time basis. Output basis, actual output divided by standard output into 100, whereas in time basis it is standard time divided by actual time into 100. We already studied about Halsey and Rowan many times. I know you people will remember the formula, but let's revise it very quickly. In these plans, we'll see a total time taken into rate plus C. The short form is this is H, right? The half is same, that means 50-50. We'll consider it as 50. This is a shortcut that I made to remember for myself. Coming to Halsey, it is 50% into time saved into total like rate. Okay, coming to Rowan plan, this thing and this thing is same, time taken into rate plus, here the formula slightly changes, that is time saved divided by time allowed into actual time taken into rate. Treatment of overtime, if it is because of labor shortage, weighted rate or higher direct labor cost, it will be calculated. Done to meet irregular production requirements, normal for direct labor, overtime premium for factory overheads. At customer request, labor cost is charged to each job with actuals. customer request to complete work in specified time. To make up any shortfall in production due to abnormal condition as flood, overtime wages are charged to a costing P&L. When it comes to attributed to fault of department, overtime wages are charged to the specific department because of whom the fault was happened. Coming to the chapter overheads, absorbed overheads actual base into predetermined overhead recovery rate. Actual overheads is given amount minus adjustments if anything, if it is there. If actual overheads is greater than absorbed overheads, that is under absorption, that is AO is greater than absorbed overheads. Normal reason treatment, find out supplementary rate and adjust cost of sales, cost of closing stock of finished goods and WIP. If it is for abnormal reason, transfer to costing P&L. For abnormal, costing P&L account to factory on control account. If it is normal, cost of sales account, finished goods control account, WIP control account to factory on control account. For distribution of overheads, primary summary and secondary summary, will be dividing it into two, that is primary and secondary. In primary, allocation and apportionment of expenses for the first time among the production and service department. For both production and service department, we have to allocate the expenses that has been incurred. In secondary summary, redistribution of overheads of service department back over the production department. See, the amount of service department should be reapportioned or redistributed among production departments. Next is that computation of absorption rate. Total of secondary summary we have to take, that we got after apportioning the service to production department. We have to take that amount. Direct labor hours, we have to take the hours. Overhead rate, percentage labor hours, on the basis of how they have given. In this case, that is labor hours, that is A divided by B will be taking, and will be getting the overhead rate. Machine hour rate, total expenses, same base but machine hour. Instead of labor hours or labor hours, will be taking machine hours. Effective machine hours is equal to total machine hours minus maintenance hours minus setup hours. If it is unproductive, then we'll be getting the effective machine hours. Computation of recovery rate. Recovery rate or absorption rate is equal to total overheads divided by base. That may be machine hour rate or labor hour rate, etc. into 100, will be getting the recovery rate. Coming to the next chapter, that is activity based costing. There are two methods in this, that is traditional method and also ABC method. Now let's see what is a traditional method and what does it say. Direct material will be taking it, direct labor will be taking it. Overheads, for this we have to find the recovery rate, amount of overheads divided by base, single type of base, that is labor or machine hour rates. We already saw that in the overheads chapter. This chapter is extension of overheads. Extension of overheads chapter. We'll be taking 1 and dividing the overheads in that rate, then we'll be getting the total cost. But in ABC method, direct material will be taken, direct labor will be taken, overheads activity wise will be taking it. That is like cost driver rate. Activity A, B, C, D and E is equal to cost driver rate is equal to B by D. Cost pool, cost driver capacity is equal to, will be getting cost driver rate. That is cost pool is equal to total amount of overheads. Cost driver is equal to the cost has been driven. From this, the cost has been driven to the activity, that is cost driver. Cost pool is total amount of overheads that has been incurred. Coming to the next chapter, that is budgetary control. These ratios provide information about the performance level, that is whether the actual performance is favorable or unfavorable. What is effective ratio? That is standard hours divided by actual hours into 100. Activity ratio is equal to standard hours divided by budgeted hours into 100. Capacity ratio or actual usage of budgeted capacity ratio is equal to actual hours divided by budgeted hours into 100. Important, we have to know that effective ratio into capacity ratio will also give you activity ratio. That is budgeted hour for budgeted production, actual hours is actual hour for actual production, standard hours is budgeted hour for actual production. Other ratios are calendar ratio, actual working days divided by budgeted working days into 100. Standard capacity usage ratio, that is budgeted hours divided by maximum possible hours in budgeted period into 100. Actual capacity usage ratio is equal to actual hours maximum possible hours in budgeted period into 100. How do we calculate flexible budget? Here first we'll be writing sales cost, sales minus, that is A minus A. Okay, first we'll take sales as A, then coming to B we'll write total. Here we'll write total of A, then coming to B, that is cost, we'll first write fixed, variable, semi-variable. We'll differentiate how the cost has been given. In semi-variable we'll divide it, and we'll also find the fixed and variable from it. Just like a change in cost divided by change in units, you will be getting the variable cost, then the remaining will be fixed cost. Then the total of B, A minus B is equal to, we'll come to know if it is profit or loss. In case of positive figure, that is profit. In case of negative figure, that is loss. Finding variable cost. Okay, we have written this also in this semi-variable, that is a change in cost divided by change in units, we'll be getting variable cost per unit. Functional budget, production budget, targeted sales plus desired closing stock minus available opening stock is equal to production units. Here we'll be finding how much we have to produce to achieve the targeted sales or targeted stock that we should have in the organization. Here after sales, and also we have to retain some stock. That means after deducting the opening stock, we'll be getting how much products or how much production will be we should be producing in the current production. Raw material consumption budget. These are just common sense based things that if we use our common sense very cleanly, we'll be getting this. No need to buy hard these things. Raw material consumption budget, finished goods production into raw material consumption per unit of finished goods, then we'll be getting how much consumption we'll be doing in this year. Raw material purchase budget, raw material consumption plus desired closing stock minus available opening stock, will be getting raw material purchase in units into material cost, will be getting raw material purchase cost, total cost, that is in price. Production budget, sales, 80% of sales of current quarter, 20% to next year, will be getting total production units. Raw material purchase budget, purchase quantity, total annual requirement into purchase percentage. Coming to the next chapter, that is job and batch costing. What is job costing? Form of specific order costing under which each job is treated as a cost unit and costs are accumulated and ascertained separately for each job. Applies when job are executed for different customers according to their specifications. To change the share of overheads on the job, recovery rates are used. In absence of any specific information, following is assumed. That is, factory overheads recovery as percentage of direct wages. In case they have not given the base, will be taking direct wages. Factory overheads divided by direct wages into 100. Admin and selling overheads are recovered as a percentage of working costs. Admin and selling overheads, that is related to the base will be working cost. These 2 points we have to remember. In case of factory, there the workers will be working, right? uh, this is works cost and direct wages. Next, that is batch costing. Technique or method of estimation of batch cost applies to those industries where production is done in bulk quantity at a time. Cost per unit is equal to total cost of batch divided by number of units in batch. Economic batch quantity is equal to, this is like EOQ. Here we'll be using other terms instead of AO divided by C. Okay, let's get into what the formula says. EBQ is equal to root 2 of AS divided by C, that is A stands for annual production, S stands for setup cost, and C stands for carrying cost. Number of batches are calculated as annual production divided by EBQ. The same thing will be followed. No need to study those things and these things again. Just check 2 to 3 problems, then you will be ready to go. Time interval between 2 batches is equal to 360 or 52 or 12. Here we have to write the assumption that we have assumed 360 days in a year, in case if they have not given, or you can write 365 days in a year according to your assumption, divided by number of batches. Setup cost is equal to number of batches or runs into setup cost. Carrying cost, average inventory into carrying cost per unit. Then we'll be getting carrying costs. Coming to next, the very interesting chapter according to me, that is process costing. It's a method of costing used in industries where the material has to pass through 2 or more processes for being final product. Separate process account is opened for each processes. Simple process account, the format is process 1 account. We'll be writing all the expenses here. Here it is like sales. Okay, before process to material to labor to overheads to other expenses, and also in case of any abnormal gain we'll be writing here. I'm sure you people know what is abnormal gain, what is normal loss, what is abnormal loss, because we are at the end of the revision, that is tomorrow we'll be writing our exams. In credit side we'll be getting by process to account. That means the product that we are sending to the other process. Here we'll be writing that by normal loss, that the percentage will be given in that, and in case of any abnormal loss we'll be writing that here. Cost per unit of output, ABL or ABG. Total cost of process, that is abnormal loss or abnormal gain calculation, we'll be writing total cost of process minus normal loss of scrap, that the amount we have recovered, divided by total units input in process minus normal loss units. That means this minus this, before we get abnormal gain or abnormal loss, this minus this will be getting the cost per unit of output that we have produced. Abnormal loss account, here see we have got abnormal loss here, so the opposite side will be recording it. This abnormal loss will be going this side by bank account in case of any normal if we have recovered anything like scrap or something we have gained, we'll be writing this here. By P&L account, debit to costing P&L account. For the loss, abnormal gain account, we'll be writing normal loss in abnormal gain account. That is, this amount will be recording in the opposite side, that is, where are we? to normal loss account, we'll be writing the amount, and by which process this side will be writing in the opposite side. We know about the policy, right? By process account we'll be writing the amount, and the other what the balancing figure will go to P&L account, costing P&L in this case. In case of normal loss account, we have written this side, that means it's probably going to this side, to process account where it has come. We'll be writing this amount. By bank account, that is scrap value. By abnormal gain account, in case of any gain that we have got from this. Sale of output of process. Process is not treated as responsible center. Sale is shown in costing P&L. Process is treated as responsibility center. In case if the process is not treated as a responsibility center, it will be directly going to the P&L account. If it is treated as responsibility center, then the profit is to be shown in process account itself. Most of the cases the process will be treated as responsibility center only. For this we have to study the question cleanly to know about it. The inner process profit is equal to, we'll be calculating that here. Process account, opening stock, material, labor, will be getting prime cost of goods purchased minus closing stock to prime cost of goods transferred. The unrealized profit will be getting here by process 2 account. That means the how much units we are sending to the other process 2. In this case, in process 2 or 3, we'll be sending it to the next process, that is process next account. Now let's get into the next chapter, that is joint and byproduct. We have also seen this in AS2, that is accounts, right? A joint and byproduct. Joint product have equal importance, but byproduct is not expected, but it comes, then we sell it as scrap. The scrap value is subtracted from joint cost. That chapter, okay. Byproduct, relatively small value which emerges incidentally in the course of manufacturing the main product. These are secondary or subsidiary products. Accounting treatment, if sales value is small, sales value may be credited to P&L account, or sale value may be deducted from total cost. Mostly this will be followed. If sale value is considerable, byproduct may be treated as joint product. If the value of scrap of byproduct is so big, then we'll be treating it as joint product. Before we know about the joint product, we'll continue this in part 2. Please wait for the part 2, and also like, share and subscribe to our channel C Aspirants. Comfort zone. See you in the next part.